But let's focus in on another big earning that came out on Friday. It was Tech Mahindra, and better than anticipated earnings could in fact lift the stock in trade today. The deferred tax gain which has aided the profit, but the top line and the margin performance, those have been the show stealers for Tech Mahindra's Q4. Let's listen into what the management has to say about the performance.
So good evening and thanks a lot for joining us on ET Now. Congratulations on a very good set of numbers. Market was expecting a healthy number and you have delivered this time on expectation, in fact done better than that. So let's start by understanding the kind of revenue growth you have clocked 3% thereabout. Otherwise environment which is kind of getting challenging. What went into this kind of a revenue growth number and what are the factors at play?
I think what we have been successful in is a rapid adaptation of new technologies, and therefore the demand for our services increased, and in fact that is one of the strengths we see going forward. The other factor obviously was our strategy of making acquisitions, picking up companies which are not doing great but very pertinent for our growth. We pick them up, it takes time, we right size them, and then we harvest the benefits. So which was the confluence of all these two factors which resulted in a growth. And I think this will continue. We will keep on buying companies which are pertinent and which are in distress of sorts, or which could do with better management, which we think we can provide, and harvest the benefits which come through it.
In fact, that has been the Mahindra way of things, because across your companies, be it M&M or Mahindra CI, you have seen these kind of strategic fit-based acquisition and then turning them around and fitting them well.
That's right. That's right.
Sir, talk to us about how the margin performance was very interesting, expansion there, and your commentary seemed to be indicating that there is perhaps further little scope on the margin front. How's that picture looking?
So yeah, margin, we worked on all the levers possible. One is improvement in the utilization. Through the year we improved utilization by about 6%. Second was the automation, which helped us to get more out of the people. Okay. Then we improved the performance of our portfolio companies, and that's helped us to improve the margin. And third is a better product mix or better services mix, as you would call them, where we focus on high margin business. So all three levers worked for us, and going forward also we will continue to work on them, but it's going to be the results may not be as dramatic as they have been last year.
So how much was the contribution from cross currency this time around, and where do you see the margin roughly settle around, or you'll be happier?
Sorry?
Where will you see the levels at which the margin may stabilize, as you say?
Let me add, happiness is a state of mind. It's not a state.
You always want to do better than what you have done.
Yes, sir.
That's the life.
Right. So your enterprise business versus the telecom business. Talk to us how the segments are looking right now, because you've guided for what, 1.5% growth in enterprise side?
Yeah, enterprise side, I think this year has done us proud. We've done rather well in that.
Let's also tell you what the brokerages are saying about their performance in the fourth quarter. CLSA says that the Q4 saw inline revenues despite the telecom drag, and the margins have been stellar and they've been continuing for the past couple of quarters, and they expect it to lag the growth recovery in FY 19-20. But they've lifted the target multiple to 13.5x 1 year forward, and they lifted the target price also to 600 from a previous target of 540. However, they retained the sales rating on the growth concerns. That is a bit of a concern for CLSA. Nomura in the meantime has maintained a neutral with the target price at 580. Margins be driven by headcount cuts is what they say. Telecom was weak. Enterprise segment is the one which drove growth this time around. Citi believes that the Tech Mahindra EBIT came in at 3%, which was ahead of their expectations. The revenue of 1.7% QOQ in constant currency terms, headcount decline continues to support margins according to them as well. They have a sell stance on the company target at 650 rupees.